Welcome to the Acquisition Headquarters podcast, where we interview seasoned operators of companies, M&A service providers, as well as investors and capital providers. Today, we have a special guest, Said. How do you pronounce your last name?
Armutcuoglu.
Okay, perfect. Managing partner of Maxine Partners, LLC, is an investment and merchant banking boutique based in Park City. With over 33 years on Wall Street, including 17 years at Lazard, Said has advised on 50-plus transactions totaling over $100 billion across mega-cap and middle-market companies. His experience includes strategic M&A, cross-border deals, complex restructuring, capital markets, and advising boards, special committees, and financial sponsors. Prior to founding Maxine Partners, he was the managing director and senior advisor at LSH Partners and a partner at Lazard. He holds a BA in economics from the University of Chicago and brings a global perspective, speaking 4 different languages. Thank you so much for joining us today on the podcast.
Thank you for having me. Thank you.
I'm excited to be able to get into, obviously, the structure of a micro private equity firm, to be able to speak to those that have ambitions to do so, as well as those who currently already do have a firm that is looking for a potential acquisition. Sure. So we'll talk a little bit about the markets today and what you're seeing based on some of the research that you continuously do to be these top subject matter in your space. But let's talk a little bit about how you've come to where you've come to today.
Sure. Yeah. So I started my career at Lazard right after graduating from the University of Chicago. I started in the Chicago office. Worked with some amazing bankers who were involved in the Argentine Nabisco transaction and others. They used to be the ex-Salomon Brothers guys. And after 2 years, they moved me to New York for the capital markets group. In banking still, but in capital markets. So I did about 2.5, 3 years of capital markets work. Public, private, debt, convertible. We used to actually have a very good convertible desk at Lazard, and high yield, distressed high yield. And then went back into banking. So that was a good, because Lazard is known for his M&A.
Yeah.
And later on restructuring. But I had some experience in the capital markets group as well, which was not a huge place, but it was very fruitful. We lead managed transactions. I learned a lot about convert markets and options, etc. And then slowly they kept on promoting me, and I became ultimately a partner in the TMT group, which is the Technology, Media, and Telecom group, right before the dot-com bubble burst. And so we were super lucky because we were actually not getting much of the business because banks were giving IPO shares to their clients and flipping them in the IPOs, because back then, I don't know if you guys remember, but IPOs were going up by hundreds of % a day.
What date was that?
This is 99,
okay,
98, 99.
Yeah, I can see that.
All that, yeah. And then so when 2000 happened and telecom bust happened, the dot-com bubble burst, we basically spent next 4 or 5 years on restructuring of telecom companies. I did Adelphia. I helped a little bit on WorldCom, but some of my colleagues did WorldCom. I was on the banking side. We had a restructuring group as well, working in each of the transactions, and it was an incredible experience. It's like when the tide goes out and you see all the naked bodies, as people tend to say. For instance, Adelphia, we went there. It was a massive fraud, and they were basically hiding $3 billion of debt. There was hundreds of millions of cash missing. They were creating like Enron-style subsidiaries where there was no value, so they didn't have to report to the board. We got hired as a special committee advising them in the investigation. And then when we found out about the fraud, the Justice Department got involved, and the entire family, which was the management team, the Regas family, were arrested. And so we had a few days to make a dip loan, make it happen, pay thousands of employees. And so you get a sense as to how things can go wrong in restructuring. And I don't want to be gloomy at all. I mean, this was a bad time where a lot of people raised a lot of money, debt money, with very little of revenues and cash flow to show for, which is a little bit different than what we're seeing today. I'm sure everybody is thinking about the bubbles today, but some of the companies that are spending a lot of money now, they have a lot of money. Yeah. So it's a little bit different than today, but some parallels.
Share with us a little bit more about the details of the definition of restructuring and why a company would need to be able to do that.
Yeah,
And then
no, absolutely.
at times within obviously the advancements and maturation of a company, there's always a restructuring viewpoint, right?
Of course,
It's not
yeah.
just about, a potential bankruptcy and then there's an acquisition. There's always a time of reflection in restructuring. So share with us a little bit more about
Sure,
that.
yeah. And unfortunately, many companies always realize too late that they have to restructure. And typical cycle works like this. So you have organizational restructurings, right? So when I started Lazard, TRW was one of the largest automotive parts and defense companies. They had too much debt. The 87 crash, hurt them significantly. Even into the early 90s, they had to constantly restructure, sell off divisions that were in core, lay off a lot of people, unfortunately, et cetera. So that's kind of a out-of-court restructuring by an organization. And the United States actually is, people get very scared of bankruptcy. The United States has the most amazing bankruptcy laws. And the British come close to it, but the rest of Europe, for instance, it's very difficult to restructure a company. And what I mean by that is if you have a company that has sound fundamentals that maybe need to change, improved, yet the problem is the balance sheet, then you have the courts to allow you to downsize the debt and, basically give a new life to the company. And which is a great thing because a lot of times when a company liquidates, which is what we call Chapter 7, you usually lose everything. I mean, you're just selling chairs and computers at that point. Everybody loses their job, etc. But in Chapter 11, there is a way to go to the courts in relatively short order, get the recapitalization going on the business that can actually sustain that much debt and come out of it clean. The bankruptcy court, the judge approves everything. So there's no litigation post-bankruptcy or anything like that. So for an acquirer, it's a great way to buy a company, just you buying just the assets. And the estate deals with all the litigation, all that other stuff. So it's a great way to buy a company. And also a good way for a company to survive and at least keep some part of the jobs. And then hopefully if they have a good product, thrive afterwards. So that's kind of the typical good bankruptcy. Bad bankruptcy is Chapter 7, which is liquidation. And bad bankruptcy is filing Chapter 11 without a plan. So we call that a free fall bankruptcy. So which means that you have no plan. You don't know who the buyers, what we're going to do, how much cash does the company need, etc. So those are bad bankruptcies. But as I said, Chapter 11 can be your friend as a buyer as well as the company itself.
Yeah, let's walk through the actual acquisition process, and I want to speak to again the micro private equity fund owner right now who is looking to potentially make an acquisition. Let's start first with what you're seeing in the market today and some of the indicators, and then also we'll then move into the tactful approach to a strategic acquisition.
Yeah, I mean, listen, compared to the pre-2008 and 2000 cycle, I mean, we have so much more liquidity in the market right now. So you're seeing, on the larger scale especially, you're seeing a lot of private equity funds or privately owned companies, et cetera, restructure out of court. And, one fund can invest in the other fund within the same house to bail out one of their operations. So for instance, just giving an example, KKR, for instance, has a portfolio company that might be a little distressed, and one of their other funds that invest in special situations can invest in that, reorganize it, etc. So there's a lot of deals like this going on. The other thing that's going on right now is what they call creditor-on-creditor violence, which is basically you're stripping out assets from underneath other creditors, put in new money, and you squeeze out some of the other creditors. That's they call it, the good word for it is liability management. That's happening, and some law firms are making incredible amount of money doing that.
Can we dive a little bit deeper into that specific scenario, and
Yes.
then what companies, service, or product would be able to leverage that?
Yeah, so those are for bigger companies. They have private credit or bank debt, different layers of debt. Excuse me. Maybe even some preferreds or convertibles, etc. So you're basically trying to change your standing within the stack of seniority in the balance sheet, right?
Okay.
So if let's say you're a senior debt holder, but you have certain assets. The covenants allow the junior debt holders to take some of the assets away, create a new entity, and suddenly the junior debt becomes more senior because they took the asset, the profitable asset. That's the type of stuff that's going on. But this is our larger scale, so this is probably less relevant for the micro private equity investor. There, it's more finding assets that have been badly managed or have debt that they can't pay, and using the bankruptcy court, and then could be a lot of litigation involved, et cetera, and using the bankruptcy process to buy the asset clean. Bankruptcy process can be very expensive. So if it's handled in very efficiently, and it's a great way to cleanse the asset for the private equity owner or family office owner, et cetera, to buy the asset without considering the headaches associated with what they just went through.
I'd ask too, the process now in the acquisition of a company, right? So I'm on a private equity fund now. I'm looking for my target, and what would you suggest, obviously, as an investment banker who's been both probably on the buy and the sell side?
Sure.
Let's run through that process and share with us a little bit about what the to-dos and the not to-dos during that acquisition process.
Listen, I've seen it many times. A lot of acquisitions actually end up being really bad.
Yes.
Special mergers, etc. We have hundreds of examples. Like Time Warner, AOL is like one example cited as the most value destructive merger ever. Literally hundreds billion back in 1999 dollars. But in terms of the acquisition, the key is after the closing of the acquisition, right? How they integrate the cultures, the integration. That's what usually doesn't work. And if you have a plan, you're going into the acquisition with a great plan of not only acquiring the company free and clear of any of the the headaches, but also have a plan post, like day one after the merger is closed, how to integrate. And that's the key for me of my 33 years of doing this. Pretty much all the deals that went bad were usually those that didn't have a good plan after the acquisition. That's kind of the number one. Number two, with respect to the acquisition itself, right now, as I said, there's a lot of cash out there to be invested, investable capital. So they're all looking for deals. They're all looking for that small cash flowing business that they can consolidate and roll up, etc. So there's competition for it. And overpaying is very easy, especially if you're playing with other people's money, right? True. If you are investing your own capital, etc., then it becomes a little bit more riskier to overpay. Overpaying is never a good thing because you can it's hard to grow into that multiple once you pay a high multiple up front. You have to have a clear strategy. Look, here's the synergies. Here are the second acquisition I'm going to make on top of it. That's going to bring down the costs because the volume is increased. You have to have a whole analysis of that. Even for small deals, I think it's important to do that.
You said something about the amount of cash that's available on the market today. Yeah. Why is that?
Well, because you have to ask, our Fed and the government, et cetera. Since 2008, we have basically had no recession. And, other than COVID, but that was very brief and everything. The government has flooded the market with debt and equity and cash. The banks, the big banks were getting like zero interest loans on a daily basis to trade, to invest. So leverage begat leverage on top of leverage. So you're creating artificial money. If Fed buys back $5 trillion of treasuries, there are multiple leverage that people put on top of that. So that 5 trillion asset purchases becomes trillions of free money, or not free money, liquidity.
Liquidity in the market.
In the market, exactly. So you're seeing that in the stock market, you're seeing that in the M&A market, multiples have increased. Typically a good manufacturing company or good manufacturing or services company used to trade at, mid to high single digits. Now the multiples are like 10, 12, 13, even though the interest rates are, I don't know how much lower they can get. They can, I guess, reduce short-term interest rates, but the long-term interest rates are not budging. So they will have to do a lot of purchases. So I don't know. Bottom line is there's a lot of liquidity. that has been created worldwide. This is not just a U.S. phenomenon. And that liquidity is chasing assets, right, to invest. Because a lot of intermediaries make a lot of money by investing the capital, right? They have to invest to make money, to make fees. And so they're rushing to invest that, and which creates multiple buyers for certain assets. And I think in the small side, you have to be very careful that you're not overpaying just because there are a couple of other people out there, and you found this nice asset, but is it really worth that much? What is it gonna return? You're seeing that in real estate too. I mean, the cap rates are ridiculously low now. They're like 1%, 2% in some of the markets.
You've said about value creation within an asset.
Yeah.
I think I would like to speak to those that are the seasoned operator who's out there building their brands,
Yes.
building their businesses. Let's speak to them about the creation of a valuable asset and one way or multiple ways that you are seeing, and then as well as an investment banker who's looking at valuations.
Yeah.
How as a business owner should we create and run our businesses to increase the value?
Yeah. Well,
To be one of those businesses that people will purchase.
To purchase, exactly. So you want to, they always say, a good business gets bought, not sold, which means that, if you're doing well and you're operating well, et cetera, you'll get interest. It's not necessarily just about hiring a banker and sending out 200 teasers and seeing or getting an auction, et cetera. It's you building the business to be attractive, right? And some people, things have changed over the years, but we always used to advise companies, don't build a business just for the exit, right? Because you never know what's going to happen with the markets. You never know, whatever. Build a business that's sustainable long-term, that is desirable to be acquired. So you buy a good business, you don't sell it. And so that's number one, in my opinion. Number two, scale is very important in today's world. Scale, automation, all the technological advancement we have. Now, if you have a very small business, scale, like applying all the technological innovation, the productivity gains, et cetera, is more difficult, right? You usually need some investment up front, whether it's software, new machinery, or whatever it is. If you're too small, that investment is difficult to make, right? Because your margins are lower, or even if you have higher margins, the dollar amount margins are lower. So in that respect, acquisitions can be great, right? As long as we follow the rule in terms of you're buying this company because it makes strategic interest, strategic mecca, and the post-transaction we can actually cut the costs down, increase the revenues, apply more, investment to it, so that we can grow faster. If you have a plan like this, acquisition makes a lot of sense to me for small businesses, because you want to have scale. And by the way, as a footnote for the exit, right, the multiples change completely between a $1 million EBITDA business and a $10 million EBITDA business. You're now when you're reaching 10 million and above, you're now in the world of private equity, real private equity funds. I know there are many tiny little private equity funds, but the institutional money wants to see, bigger companies because they want to deploy more capital. So if your EBITDA, it reaches a certain amount, let's say after 5 million, definitely after 10 million, your valuation is going to be also very different.
Share with us a little bit about the valuation in comparison for a company that is a 3 to 5 million EBITDA,
Yeah.
and then also a 10 million, and how
Yeah.
the valuations.
Well, valuation,
and I'm sure it's
yeah.
pendant on the specific industries.
Sure, absolutely. Depending on the specific industries, growth determines multiples, right? And but you can apply. First of all, you can use capital markets at a larger acquisition. If the private equity comes in, they have lending relationships. Those lenders, everybody wants, because the amount of work you're going to do for a $5 million company versus $15 million company is pretty similar in terms of due diligence, et cetera. But if you have a $15 million EBITDA company, you're dealing with a much larger scale, and hence you can utilize private capital markets, private credit markets. You can attract co-investors, so you have a much better, or a broader set of tools that you can apply to that acquisition. If it's very small, the fees alone can eat into the
Yeah, I could see
so that's the problem, like, right, even in the bankruptcy nowadays, the fees have been so inflated that smaller companies are having a hard time actually restructuring in Chapter 11, and becomes more Chapter 7. Same applies in the M&A, where if you have a larger business and it's well integrated, etc., that's going to have a much higher multiple, maybe even double, a multiple, especially if you have a growth path that you have established through this acquisition spree.
Making acquisitions and understanding and also having more of a private equity roll-up strategy,
Yeah.
I believe could be very advantageous for one that runs, a company that's looking to acquire another company.
Yeah.
But what are some of the things that you're seeing that people fail to do
Yes. Yeah. So
during the roll-up process?
Yeah, but a lot actually, and we've seen this before. Like in the early days, before this technological revolution in 2000s, there was like staffing companies or service providers that private equity funds rolled them up, and now they're rolling up, pest control companies, rolling up, all good, right? Makes sense. On the paper, if you have a fixed cost spread over a much bigger revenue base, then you're going to make much more money if you have a larger business. The problem is people, right? Number one, people, meaning like you acquire one and then his non-compete expires. He opens a store next door and takes some of his clients with him. So in the roll-up strategy, you have to be very careful that it's not you're not rolling up different cultures that will never match with each other. It's really a people thing, because we can do a financial model, sit there, work 24 hours, 48 hours, build a beautiful LBO model, rolling up a bunch of these companies, and we have done that many times. But the answers are not in the spreadsheets, right? The answers are all those companies or people that we're buying bring into how are we going to keep them incentivized? How are we going to keep them not compete with us, et cetera, et cetera.
Yeah. Help me understand a little bit more of the transition, and also the team that's been put together, and what are some good ways to be able to create a team and then be able to set precedents as one company is purchasing another. Yeah. So in essence, pre and post integration.
Yeah,
success.
No, it's very important. I mean, some of the deals that I've seen very successful, like Fisher Scientific, right? That was a family that started acquiring this small medical tech, laboratory equipment, etc. Became one of the largest in the world, and they merged with Thermo Fisher. Now they're Thermo Fisher, etc. And so they started as a family office acquiring some of this business. They had an amazing team. Due diligence, small, not much. We used to help them at Lazard very quietly all the time. Small team, very professionally managed. No questions unanswered. Very disciplined due diligence process. And at the same time, operating guys who have done this before, that are on the side, working side by side with the financial guys. You see, the financial guys, you can make everything work, because, pardon my language, but garbage in, garbage out, we call it. Like if you do a business plan, LBO, whatever model, you can make assumptions, and there's so many different little things that can change the outcome. But the operational guys, if they are also very savvy about financial aspects, or they work together, they can identify what actually is doable and not doable. You can assume like, well, combined company, we're going to grow 10%. Where did that number come from? Because the industry is growing this, take market share. So you're making tons of assumptions in each time. So, but the guy who's actually going to go and sell the products, he's going to know what he can get there. He has sold his products before. Now he's got a bigger sales force, etc. So his input or her input is extremely important in deciding what post-transaction this company is going to look like.
How did the Fisher family, like you said, how, through your observations, were they able to make and continue to make acquisitions that were success?
Yes.
As opposed to some of the other ones that weren't.
Yeah, I mean, they were, because as I said, they were very disciplined.
Okay, disciplined.
Disciplined.
Okay.
And
setting culture correctly.
Exactly.
Yeah.
Great culture. They located in New Hampshire afterwards, changed the laws there actually for trust laws and everything. And anyway, but that's just one example. We've seen, and then you have corporate, like where the ownership is public, let's say, right? So the management team's ownership is limited, etc. They're playing with other people's money, and so you have to be very careful. That's why a lot of mergers, public mergers, etc. When you look in the hindsight, they haven't really worked out because the integration issues, the cultural issues, etc. haven't been figured out beforehand. So when we were advising companies and doing acquisitions, we would manage HR as like one, top of the agenda, right? Yes,
Yep.
legal,
HR first thing.
Exactly. So HR, the actual synergies, are there any? Are they real? Based on what? With real data instead of just guessing or percentages. So some of the bigger companies that have done tons of acquisitions and didn't do well are people who wanted to grow for the sake of growing, right? Especially in the media world, has happened many times. Technology nowadays, it seems like they're buying a lot of companies and paying a lot of money. But we started the year thinking that we were going to have a horrible year after the tariff announcement in April, whatever. Now it looks like we're going to have a record M&A year. And next year looks, because the environment for regulatory environment has loosened a lot. So there's an animal instincts that are going to come up, and people are going to want to merge. And private equity has held assets for way too long. They keep on putting it into continuation funds. The IPO market is okay, but it's great for high growth, that type of stuff. And so that typical, 3, 4, 5% growing private equity owned company, might not be able to go public.
Yeah.
So
What are you seeing with the micro cap and small cap acquisitions, and then also that space? Do you think it's going to continue to expand again? Because we have a lot of private groups that have capital that are looking to deploy other than just, your public markets.
Yes,
So
absolutely.
can you share a little insight to
Yeah,
that?
I mean, my view is that if you look at the number of publicly traded companies, has declined dramatically over the last 10 years. I mean, some people call it because of Sarbanes-Oxley. Some people think it's a regulatory issue, whatever, But there has been a lot of money put into private markets. I mean, the private credit market is now over $1.7 trillion. And remember, you can leverage on top of that. So it's really a lot, trillions we're talking about. And so they're always looking for deals. And in the smaller micro, et cetera, space, I think it's essential for the health of the economy for that to continue, right? Because we're investing in businesses. Many small businesses don't survive. They disappear over time, either by being acquired or by going out of business. And if there is a smart capital that is consolidating them, giving them a better chance of succeeding, that's a healthy thing for the economy, right? And creative destruction used to be called. Now we haven't had that for a while, so we're living it more in the investment cycle and more in the M&A cycle. So I think that's a good thing, and it should continue, and I think it will continue, because the funding sources are, pretty secure right now, unless there's a, black swan event, as they call it. The markets are pretty open to funding whatever comes in front of them.
Yeah, I'd like to end out here on this kind of question, right? So for those out there that maybe have some additional capital that they're looking to deploy, let's just speak to that person right now. And they're, like we just spoke about, they're the private markets. There are the various, growth equity plays and family offices, like you said, that are private, making these deployments. Where would you look to place capital right now and then also into the future?
Yeah, I mean, listen, I'm particularly interested in defense and aerospace lately, because I think it's a secular trend that we have underinvested all over the world, other than our enemies. And so we have to catch up very quickly. And not only here in the US, especially in Europe and other parts of the free world. And so I think there's going to be a lot of demand for new technologies, but manufacturing on scale. Right, you want to be able to manufacture thousands of units of drones, not one, for $10 million.
Manufacturing at scale within defense.
And so you got the manufacturing with robotics and new technologies, so it's not as expensive as it used to be, right? So onshoring, nearshoring, these are all trends that I think are good. And I think the country was ready, right? We have, imported too much essential stuff.
True.
I mean, I'm not talking about toys and stuff like that. I think there are some political problems there. But in general, for the economy, I think we're nearshoring, we're bringing back some manufacturing, high-end manufacturing. Defense and aerospace is definitely a clear area. And then you have, of course, healthcare. That's always going to be a big market. There's so many problems. Anyone that can save dollars in the healthcare is going to, be a good player and sought after player. And then, other industries. I mean, AI obviously is changing a lot of stuff, right? And it's hopefully for the good. But I think there is definitely some hype, just like in the dot-com bubble. So I will be careful about what AI, exactly what.
Yeah, what AI, and
exactly.
what is its use case?
Exactly, what is the use case, etc. But deploying AI tools as they become available. Ken Griffin was being interviewed today. He was saying, somebody gave me a report from ChatGPT. He said, the first paragraph was amazing. Really, I learned something. Ken Griffin, this is what we're talking about. And he said the rest of the report was junk. Why? Because ChatGPT, it's just not ready yet for everything.
I see
but
that.
I think it's going fast. It's going great. I think, utilizing AI or tools, technological tools to improve manufacturing, to squeeze out more margins, nearshoring, those are all themes that make sense to me. But what scares me is roll-ups and other stuff that depend too much on people. So if you're buying companies, businesses based on people, salespeople, especially highly paid salespeople, etc., that's a red flag to me, because they could leave any moment.
True.
Right, and then and you're left with something that you paid up front, and you're supposed to get returns over time, and now you have trouble. You have problems in the business.
Yeah, so strategically look to deploy capital on systems of automation that do have people, but not to the certain extent as to what you just said, right? Various amounts of salespeople that could potentially, impact or leave the company, right, in a bad way. Well, guys, today has been a wonderful podcast. I don't know if you've liked it or not, but if you have, make sure to like it, as well as subscribe to the YouTube channel, the AHQ Podcast. We've got one last question, and this would be for you, is how do people get a hold of you? And then how are you consistently serving companies at the moment?
Yeah, so basically after my career in Lazard and New York, let's say, I moved here in February. So we're relatively new here. But I've already, developed some good partners, brought on some good partners, et cetera, that are helping me out. The website is Maxime Partners, MAXIME Partners. .com, and my cell phone number is listed there as well, 917-816-7244. LinkedIn, you can find me. I'm like an open book.
And then the individuals that you're helping is for potentially through the acquisition process of a company, as well as the cap stack and also exiting.
Everything. Yeah, everything. We can do even consulting, etc. I'm just not the perfect guy for startups.
Okay.
But I have friends who can help with that.
Yeah.
And so we can do jointly with them. I'm more for a little bit more of a cash flow type of guy.
Yeah, absolutely.
But that being said, I'm very, very excited. I love technology. I've covered technology for a long time. And so, I'll be willing to help anyone. But with respect to helping companies, especially smaller companies or acquirers with due diligence, capital stack, structuring the merger, negotiating, auctioning companies. This is something that I've done for 33 years.
Sounds like you just know it like the back of your hand.
Well, it's not because I'm super smart, or just that
you sound pretty smart to me.
It's just I've done it so long that it comes natural.
Yeah.
And so I'll be delighted to help any company here in Utah.
Well, we're thankful for your time today on the podcast. Another thing I'm really thankful for is you being a part of the Acquisition HQ Founding Member Club. So we just want to say thank you again for that. And we're excited to be able to continue to expand with you throughout the nation and continue to provide valued information just like what we've done today. And if you guys like today's episode, again, please make sure to subscribe and also share this with your friends. We look forward to shooting more content just like this for you. Thank you, guys.